Hey everyone, this is Kirk here again at OptionAlpha.com, where we show you how to make smarter trades. And in tonight's video update, I want to go over all of the trades that we made for Monday, April 13th. So to kickstart the week, we did some things that we talked about earlier with premium members on the strategy call on Sunday night, especially the closing of our BIDU position where we kind of mentioned that, and the closing of just our long PFE or Pfizer remaining call from the calendar that we had last month. So we just kept those 36 calls and closed them out. But let's actually first, before we jump into that, go through our earnings trade today. So we did have one earnings trade, and that's in J&J, which is Johnson & Johnson. Has fairly good implied volatility. Now, I'll say it doesn't have great implied volatility, but of really the choices that were available today, really Johnson & Johnson, JP Morgan, Wells Fargo, this one seemed to be the better of the trade. So that's why we kind of went with this one and did a little bit different because just of the history of J&J. But just to kind of go through the logistics real quick, we went ahead and sold an iron condor, but it's really an iron butterfly because our short strikes are exactly the same at 100. So you'll notice on the call spread, we sold the 100 calls, bought the 105 calls. Then on the put spread, we sold the 100 puts and bought the 95 puts. So you can see in both cases, our short strike is pinned right at 100. So we're playing it a little bit directionally bearish just on where J&J closed at the end of the day, and it definitely closed towards the low end of the day. So maybe it might continue to move lower after earnings tomorrow. Took in a nice credit of 225, which is definitely a good credit that gets us near the expected move. So here's a look at J&J, and you can see implied volatility is in the 46th percentile. It's not incredibly high, but it does have a pretty good history of seeing that IV crush even from these levels where we see a good drop in implied volatility. You'll notice that it had a really, really big drop in implied volatility the last time that we went through earnings back in October, or 2 times ago when we went through earnings. But I definitely think that J&J is the better of the trades because it just doesn't tend to move all too much around earnings. So you can see most of the earnings events that it has, it moves, maybe $1 or $2, but it doesn't, jump, $5 or $10 or so. So it looks like it's going to be a pretty decent trade. As far as the options go, again, here's our position. We went ahead and did the April contracts, and the reason that we did these is because they are the frontmost contracts, so they're acting basically as the weekly contracts right now. Now again, we play this a little bit directionally bearish, so the stock closed at 155. We did the short strikes right at 100, so we're just a little bit bearish, and the expected move on this trade is about $2. So the market is expecting J&J to move at most about $2 or so on average tomorrow when it opens up after earnings. Now, remember, the credit that we took in was about 225, so that was more than enough to cover that expected move on either side of the market, with a little bit of extra, pennies and cents there. So right now we have a pretty good credit going on, and we should hopefully make a pretty decent premium and profit if Johnson & Johnson does fall. Now, just real quick before I head into the other trades today, this is a look at JP Morgan. Now, the problem with JP Morgan and the trade today that we were looking at with them is that implied volatility just really isn't that great in JP Morgan. It tends to be a big mover, right? So when you have implied volatility that's not that great, it's in the 34th percentile, so it's about 10 points lower than where J&J is. And again, tends to be a pretty big mover, and even all the way on the left here, you can see it's gapped up a pretty considerable amount, $4 or $5 or so. So it's a bigger mover with implied volatility that's fairly low, and you just can't get enough premium to do anything. So if we were to do something a little bit further out of the money, say, the 60 puts and say the, 64 calls, we could only get about 24 cents between the, about 25, 30 cents between the two of them when they were trading today. So it just really doesn't give us a lot of premium and options and not worth the risk in making that trade. Now, a couple other trades that we did exit today, our calendar spread in IWM. This was our 124 put calendar spread, so everything was pinned right around 124 on IWM. Exited today for a 134 credit, so very small profit, basically a scratch trade. And the cool thing is that IWM really didn't move anywhere close to our strike that we wanted. We were trying to get everything a little bit lower at 124. And it moved away from that, but it didn't move too far, and implied volatility did kind of pop today, which gave us a little bit of help. It went from 0 to the 17th percentile, so that, again, just gave us a little boost. Our diagonal spread in BIDU, this is what was left over from our calendar spread in BIDU. We exited today for a 156 credit. Now, this is a really cool trade, and for the reason that it's cool is because, and I'll go over here in a second, all the adjustments that we made, because after all the adjustments, we ended up taking just a $57 loss. And you're probably thinking to yourself, why am I so happy for a $57 loss? Because this proves that you can make adjustments to reduce risk along the way, especially with a stock that's moving completely against you. So the one side that we never touched our 195 puts that were long in May, and we continue to roll up our short puts from 195 to 202.5 to 210, taking in a credit every time we rolled those short puts up in April, as BIDU continued to rally higher and higher. So again, after all of the adjustments, we only took a very small loss. So here's a look at BIDU. Again, the stock went completely opposite of what we wanted to do. We wanted it to go down to 195. That's where we had our position. And had we done nothing, we'd probably be looking at a $300 or $250 loss here without doing any adjustments. Now, we got implied volatility to rise. That's great. That's exactly what we wanted. But the stock just didn't move in the range that we expected. So here's a look at BIDU over the last couple weeks. And you can see here that our first initial trade was right here. This was our first trade in BIDU, this 360 debit. And notice every single time that we made an additional adjustment in BIDU all along the way in May and April, we continued to take in a credit. And that credit just helps reduce the cost of that 360 all the way down the entire time. So we just kept taking in a credit and a credit and a credit and a credit. All the while BIDU is moving against our position. We just made smart, systematic adjustments. And you can see kind of the timeline here. So, we were very, systematic about how we approached it. We didn't do it too fast, too slow. There was pretty even spacing there. Just continued to make adjustments along the way. So really cool example of making an adjustment and reducing risk in a calendar spread. And again, the Pfizer thing, that was basically a scratch. We took care of that one and kind of tallied that one up last month as a small loser. But we made just a little bit of money back here. We didn't think that we could sell the callback for anything. It was kind of a lottery ticket that we were holding. So we were able to get it out of our hands for a $9 credit, basically covered commissions and made a couple bucks on it. As always, hope you guys enjoyed these videos. If you have any comments or questions, please let me know right below here in this page of the membership area. And until next time, happy trading.